Hello, and welcome to my channel, Be Knowledgeable. Hope you find the information useful, and if you do, please like and subscribe. In this episode, I'll be talking about RRSPs. First and foremost, a disclaimer. This presentation is meant to help you get a good starting point in terms of understanding this product, as I've interpreted them based on my research and experience. Now, each person's situation is unique, so it is highly recommended that you do your own research and not be afraid to ask your issuer questions regarding areas you don't understand. With that in mind, let us move on to see what exactly an RRSP is. RRSP stands for Registered Retirement Savings Plan. So it is simply a plan registered with the government to help you save for retirement. You and your spouse or common law partner can contribute to the plan. There are two ways your contribution to the plan counts. One is as a deductible that is used to reduce your taxable income, and the second is as a repayment for money previously borrowed from the plan. I will get into this in more detail later. Any income earned in the plan is tax-free. You start paying taxes on the money from the plan when you start withdrawing money from the plan. The exception is if you withdraw money from the plan as part of either the home buyers plan or the lifelong learning plan. I go into more details about these exceptions later. Please note that in order to qualify for them, you need to be a resident. On this slide, you can see that for the working period, your annual earned income typically increases with your work experience, unless of course you make a career change. As a result, you will be entering higher tax brackets over time. This is where the RRSP can really help you, as your contributions reduce your taxable income. This is also why withdrawing from your plan can impact you negatively, as it can lead to you paying even more in taxes, which is of course based on how much you withdraw and if your withdrawal puts you in a higher tax bracket. During retirement, you live off your pension, investments, and savings, and it is assumed that you've paid off most of your debts, including mortgage. Hence, your annual living expense will be less, so your required annual income is less, and thus your taxes are also less. So any withdrawals you make during your retirement years will result in less taxes paid than if you withdrew them during your working years. One of the advantages of the plan is that it is difficult to take money out compared to a regular savings account. Why? Due to the taxes you'll pay on the money that is withdrawn. It also helps reduce your current taxable income, as I've shown before. Thirdly, you can use it to lend money to yourself for a down payment towards the purchase of your first home, or for further studies. There are some restrictions with these two plans, so be sure to check out my videos on these two topics. So what are the cons of an RRSP? It is difficult to take money out, especially if you're going through a difficult period and you're still contributing to the plan to help reduce your taxable income. Any money you take out counts towards your taxable income for that year, possibly leading you to pay more in taxes. There are limitations on use of the plan prior to retirement. As mentioned, you can only withdraw money tax-free for the home buyers plan and the lifelong learning plan. And although you can use the lifelong learning plan multiple times, you may use the home buyers plan only once, especially if you don't sell the house. You can't use the money to pay off your mortgage or as a down payment for another house in general. There are restrictions to contribution limits for the home buyers plan and the lifelong learning plan. Any contributions you make towards the plan just goes towards reducing your taxable income and saving for retirement. Given that this is the goal of an RRSP, I guess it's not a real disadvantage, especially given there are other products that you can use as a temporary savings plan. Now, deduction versus contribution. These are sometimes used interchangeably. You can make a contribution to your RRSP. This contribution helps reduce your taxable income. This reduction is your deductible, as it is deducted from your annual taxable income. Hope that clarifies things a bit. Hence the reason why sometimes it's used interchangeably. This is a sample NOA summary. As you can see, your RRSP contributions would fall into the deductions from total income portion, shown here by the red line. Now let's look at some key terms. Deduction limit. This is the maximum amount you can contribute to your or your spouse's or common law partner's plan. An unmatured RRSP is a plan that is not yet paying out income. Think of it like a new plant that is not yet bearing fruits. A matured RRSP is one that is now paying out retirement income. With the plant idea, it would be synonymous with the plant now bearing fruits, and you're now eating those fruits. Annuitant is just another name for a contributor to the plan. RRSP contributions. You can contribute to your plan until the age of 71, as well as your spouse's or common law partner's plan until they turn 71. The maximum you can contribute to your plan is the lesser of A, 18% of your income, or B, $26,230, which is calculated as being 18% of $145,722.22. So if your income is greater than this, then the maximum you can contribute to your plan is $26,230. Your contribution limit is based on your previous year's income and unused contribution room. If last year you had a contribution room of $10,000, but you only contributed $5,000, then you have unused RRSP contribution room of $5,000. So this is added onto your next year's contribution room. Canadian residents working in the States can deduct their contributions to a qualifying US retirement plan, like the 401k, up to the total deduction limit. Contributions made by March 1st of the current year can be counted towards the previous year's contribution limit, or you can count it towards the current year's limit. Your annual contributions must be less than the limit specified in your previous year's NOA plus $2,000. Contributing more than this will lead to you being subject to possibly paying 1% interest on any excess amount per month. As mentioned in the previous slide, the contributions you make to your plan can count towards either your deductible limit or as a repayment of your lifelong learning plan and/or your home buyer's plan. Let's say you have to repay $1,000 to your lifelong learning plan, and in the current year you contributed $5,000 to your plan. Now $1,000 must go towards repaying your lifelong learning plan. Otherwise, it may be counted towards your annual income for that year, and you might pay taxes on it. So in the example, you will assign $1,000 towards the LLP, and the remaining $4,000 will count towards your deduction limit. That reduces your taxable income. RRSP lump sum withdrawals. Now, it is important to note that if you plan to make a lump sum withdrawal from your RRSPs for reasons other than the home buyer's plan or the lifelong learning plan, you will be subject to withholding tax that is applied directly to the withdrawn amount. The withholding tax rates are as follows. Amounts less than $5,000 are subject to a rate of 10%. In Quebec, it's 5%. Amounts greater than $5,000 but less than $15,000 are subject to 20% rate and 10% in Quebec. Finally, any withdrawals greater than $15,000 are subject to a 30% tax rate and 15% for Quebec residents. On this slide, you can see that you don't pay taxes on the money going into the plan, and any income earned within the plan is protected from taxes. You only need to start paying taxes when you start withdrawing money from the plan, which is subject to the withholding taxes mentioned in the previous slide. Remember that the taxes you pay is based on your annual income, from whatever source you get your income from. Some incomes are subject to less taxes than others, but that's a discussion for another day. So, when you withdraw money from your plan, yes, it is subject to withholding tax, but when you file your taxes the next year, your annual income is determined along with the applicable taxes. So if it is found that you have paid way too much in taxes due to the withholding tax, you may be eligible for a tax refund. As an example, say you withdraw a lump sum amount of $30,000 from your RRSP, and your annual employment income is $47,000. In the year you withdrew the lump sum, a 30% rate is immediately applied to it, reducing your withdrawn amount by $9,000, leaving you with $21,000. With an income of $47,000, you would have to pay 0.15 times $47,000, which is $7,050 in employment income tax. So in the previous year, you would have paid a total tax of $9,000 plus $7,050, which equals to $16,050. In the current year, when filing your taxes, it declared that your annual income was $30,000 plus $47,000, which is equal to $77,000. If basing the taxes only on the highlighted federal tax rates, for simplicity's sake, then the total taxes you should have paid is 0.15 times $47,630, since the 15% tax is applied to that tax bracket, plus the 0.205 times the difference now between your annual income, which is $77,000, minus the $47,630, will give you $7,144.5 plus $6,020.85, which is equal to a total tax of $13,165.35 that you were supposed to pay last year. As you can see, you have overpaid in taxes by $2,884.65, which is just the difference between the $16,050 and $13,165.35, which you might then get as a tax refund, all other factors being held constant. Your limit is mentioned on the previous year NOA or on your T1028. As mentioned before, your deductible can be greater than the deduction limit due to unused room from the previous year. You can't claim deductions for the following: capital losses. The same way the government does not partake in your capital gains within your plan, they will not partake in your capital losses either. So no taxes on your capital gains, but no compensation either for any losses within the plan. You can't claim deductions for administrative services, nor brokerage fees. You also can't claim deductions for interest paid on money borrowed for contributions. During RRSP season, there are a lot of banks that encourage you to borrow money to contribute to your plan as a way to increase your tax refund. and then use some or all of the refund to pay back the RSP loan. However, you cannot claim the interest from it. But sadly, you can't claim interest for the money that you borrowed. So, the government starts from your previous year's NOA, then subtracts last year's contribution by you and your employer. What is left is your unused contribution room from last year. This is then added to your current year contribution limit, which is the lesser of 18% of income, or $26,500, as mentioned previously. Any pension adjustments is subtracted, and finally, any pension reversals are added back to result in your new deduction limit. Now, if you made contributions the previous year, reported it in your taxes, but did not put that contribution towards reducing your taxable income, nor as a repayment to your HBP or your LLP for whatever reason, then this amount is still available for use this year. Hence, this amount is subtracted from your deduction limit, given that you've technically already made the contribution. All you need to do is just assign it towards either your deduction limit or repayment for the HBP or LLP in order to determine your contribution amount for the current year. Spousal or common law partner RSP. This is a way to even out contributions within the family. You cannot exceed your limit specified on your NOA even though you're contributing to your spouse or common law partner's plan. Now, either you or your spouse can claim the contributed amount. If you made the contribution but your spouse claims it on their tax return, this could increase their tax refund, and as a result, the family's combined tax refund. If your spouse is younger, you can continue to contribute to their plan, thereby reducing the family's combined taxable income until they turn 71 years old. Home buyer's plan. Now let me give you a brief summary about the home buyer's plan. This video is getting long, so I created a separate video about this. Please feel free to check it out. This plan is for first-time home buyers or a related person with a disability. You can borrow up to $35,000 that you can put towards a down payment for your first home. The withdrawal must be made in the same calendar year. What does this mean? It means you can't take out some this year and the rest 2 years later. Prior to use, the full amount you plan to withdraw must have been in your account for at least 90 days. To make the withdrawal, you will need to complete a T1035 form, which is a request to withdraw money from your RSP for the home buyer's plan. This is usually done through your issuer. The money you borrow must be repaid within 15 years. So you can pay it in one lump sum or on a yearly basis for 15 years. Since you lent the money to yourself, there is no interest that you need to pay on it. Hence, to calculate the yearly repayment amount, it is simply the borrowed amount divided by 15. For the same reason as the home buyer's plan, I created another video where I talk about the lifelong learning plan in detail. So please feel free to check it out as well. This plan is intended for you pursuing full-time studies in a qualifying program at a designated educational institution. Part-time studies is possible if you meet the disability conditions. This plan can be used multiple times so long as you've paid yourself back the previous borrowed amount in the year before you plan to borrow the money again. You can borrow up to $20,000 maximum. This amount is available to both you and your spouse, and you can use it at the same time. The maximum amount of time you can take to repay the borrowed amount is 10 years. For the reason that you lent the money to yourself, you don't need to pay yourself interest. The calculation for the repayment amount is simply the borrowed amount divided by 10. Failing to make your payments may lead to this amount being added to your total annual taxable income on which you might find yourself paying additional taxes on. So what are qualified investments that you can make in your RRSPs? Investments you can have within your plan include cash, government and corporate bonds, GICs, stocks. You can have an RRSP with a broker, which enables you to manage your investments yourself. And finally, mutual funds. Opening an RRSP. You can open an RRSP through a financial institution, insurance company, trust, or credit union. You can also set up a self-directed RRSP for greater control of your investments. You can make contributions to the issuer. And finally, although you can open multiple RRSP accounts, keep it in mind that your total contributions for that year in all your accounts, including your spouse or common law partner's account, cannot exceed your specified limit from your NOA. We've come to the end of this episode. Thank you for watching. If you enjoyed this presentation, don't forget to give it a thumbs up. If you have suggestions, please leave them in your comments below so that I can make more useful and helpful videos. Finally, please subscribe and turn on your notifications so that you can be aware of new informative videos from this channel. Have a great day and start taking advantage of your RRSP today.